So now we'll go ahead and get a quick refresher into the risk return trade-off and diversification and how it works. So we will get into some aspects of this into a lot more detail later on in the semester, but this is some background stuff that I think it's helpful to know. So let us suppose that we have two asset portfolios, two assets. One is a stock fund, one is a bond fund. You can think of it as a stock mutual fund and a bond mutual fund. And let us suppose the economy can either do badly, it's a recession in the future, or it can be in the normal state, or it can be doing exceedingly well in the future. And for now, we'll simply assume that these are all equally likely. And let us suppose that under these three scenarios, this is how the stock fund will perform, and this is how the bond fund will perform. Okay, so you can immediately see that when the economy is doing well, the stock fund will do well, whereas the bond fund is not doing so well. Okay, whereas the reverse happens when the economy is in a recession, so the bond fund does pretty well, whereas the stock fund doesn't do as well. One can think of it in very simple terms. For example, if the economy is in a recession, what happens? The earnings of these companies are going to be lower because the economy is not doing well, and therefore their cash flows are going to be lower, so their values are going to be lower. But what happens to the bonds on the other hand? So typically when the economy is in a recession, the government might want to go ahead and try to provide some kind of a boost to the economy, and they'll try to do that by reducing interest rates. So what happens when they reduce interest rates? What happens to bond prices? So they're going to go up because bond prices move inversely to interest rates. So the bond prices will go up, and that is why typically you'll see these bond funds will do well when interest rates decline. So what we'll see is in the next slide, so we'll go ahead and see how this diversification is going to work. And I'm going to show you an Excel spreadsheet where we can see that compared to just holding the stock fund or just holding the bond fund, if you hold an equally weighted portfolio, 50 stocks, 50% in stocks, 50% in bonds, it actually has less risk than either of those two put together. Okay, so we'll see how that works in just a minute. Okay, here are all the numbers from the stock for the stock fund and the bond fund from the previous slide. Okay, so here are the returns. Economy does poorly, normal state, and in a boom. So you can calculate the expected return. All right, so that is just the average. We're assuming these are equally likely. So you can calculate the expected return for both those portfolios. You can calculate the variance of returns, okay, for both those portfolios, and then the standard deviation will just be the square root of the variance. I can also calculate the covariance, okay. So I'm just going to go ahead and see. So this is now my covariance between these returns, okay. So let me just copy that here for a minute. So I can go ahead and copy that and put that here. Okay, so there we go. So this equals covariance of these and that. Okay, and then the correlation is just covariance divided by the product of the two standard deviations. Okay, so these are almost perfectly negatively correlated, which is obvious when you see this. So when the return on the stock fund is going up, the return on the bond fund is going down. So they're almost going exactly opposite to each other. So now what I can do is to see and create portfolios of the stock and bond fund with different weights. So my first and these are just sample examples. I just took 10% cutoffs. You can use obviously any percentage. You can use you can also have negative weights if you want. But we are just going with weights of 0 in the stock, meaning 100% in the bond. And then I can calculate the portfolio return and then the portfolio variance. All right, so that's the formula for portfolio variance. And then the standard deviation of this is now my portfolio standard deviation. Now I can say instead of holding all bonds, let us say 90% of my portfolio is bonds, 10% is in stock. And then I can do the same thing. Calculate the portfolio return, calculate the portfolio variance, and then the standard deviation. Okay, and I can go all the way to 100% stock and nothing in the bonds. And this you can see kind of makes sense because when it is all stock, so you only have stocks in the portfolio, the stock fund. So your portfolio return should be the same as the return on the stock fund, and the standard deviation should be the same as the standard deviation on the stock fund. Okay, and similarly for this. So my portfolio formulas are all correct. Okay, now I've gone ahead and plotted this on a picture like this. Okay, so this is now my portfolio frontier. Now what I want to show you is what is going to happen if I change these covariances. Okay, so let us suppose I'm going to put my covariance as 0.007. All right, positive, so 0.007. Now you can see the correlation is pretty high. That means these two assets are going to move closely together. So their returns are not like this. They're moving closely together, but they're positively correlated. So that means they're almost like each other. So you're not getting any big diversification benefits. So your portfolio frontier is looking like this. Okay. What happens if I reduce the covariance a little bit? So let me say I make that 0.003. Now the correlation is only 0.25, so they are less correlated. But now you can see the portfolio looks like this, the frontier. So you can see this is now my portfolio standard deviation or sigma, that's my risk, and that is my portfolio return. Okay, so you can see going from here to here, I am actually reducing my portfolio standard deviation, I'm reducing my risk. That is basically what diversification does. It allows you to reduce risk. Now, we didn't get much of a diversification benefit with this high correlation, but that's because they were similar. So you're not holding a diversified portfolio. You're holding pretty much two items which are similar. Once the covariance is lower or correlation is lower, then you start getting to see these diversification benefits. What happens if I reduce it even more? So can you take a guess as to what should happen? Yep, that's right. I should go ahead and get a steeper decline in the portfolio risk. So now my portfolio risk is declining even more at this point. I'm able to reduce my risk even more. I'm getting greater diversification benefits because now the correlation is even lower. It's actually negative. What happens if I make that even more? You can see I get an even bigger diversification benefit. And what happens if I keep the covariance as minus 0.01? You can see the correlation is minus 0.85 and I'm getting an even bigger reduction in portfolio risk. So this is basically how diversification can help reduce your portfolio risk. Okay, once you hold assets which are not highly correlated, that is basically when we say you hold a diversified portfolio, and that is basically when you can get the benefit of risk reduction from diversification. Okay, so now let's go back to the PowerPoint slides. So you can see that once you hold a diversified portfolio of stocks and bonds, you're able to reduce risk. Okay, you're able to reduce the risk. So this is basically this is a 50-50 portfolio, 50% in stocks, 50% in bonds. But what you can see is if your only objective is to reduce risk, you can do even better by coming here, which is basically 40% in stocks, 60% in bonds, and you can actually see your portfolio risk is even lower. So you can go ahead and see this is basically what we'll call the minimum variance portfolio. This is the lowest portfolio risk you can get with these characteristics. Okay, for stocks and bonds, for the two assets we're looking at. Now, this top part of this portfolio frontier, so this is something that we'll call the efficient frontier. Why is this efficient? Because you can just compare this point, compare it to this on the lower part of the curve. So what is the comparison? So the 2 points have the same level of risk. Okay, but this one is giving you a higher return because the return is higher, here the return is lower. So this portfolio is preferred to this. So you can see for each point on this bottom line, you can have a point on the top part of the curve which is going to be better, which means the level of risk is the same, but your return that you're going to get is higher. Keep in mind, we said that people prefer more money to less. That means they prefer a higher return to a lower return. That means all of these portfolios are going to be more preferred compared to these. So these are more preferred. So that is why they were called the efficient frontier. Now, when you go ahead and have assets which have perfectly correlated returns, then obviously there's going to be no diversification benefit. So all the portfolios you can form are going to fall on the straight line. But what happens once the correlation is lower? Then the portfolio frontier starts curving back, and the lower the the correlation between the two assets, the lower is going to be your portfolio risk. The greater is going to be the benefits of diversification. So this diversification can reduce the variability of returns. All right, so that's a basic advantage. Now, what kind of risk can it reduce? Keep in mind, we had said that there are two types of risk. One is systematic risk and one is the unsystematic risk. The unsystematic risk is the firm specific risk, and we said that is something that you can reduce by diversification, because something that happens to one part of your portfolio can be offset by opposite happenings in the other part of your portfolio. So you can eliminate this diversifiable or unsystematic risk. The risk that you cannot avoid, you cannot diversify away, that is the systematic part of risk, the systematic risk, market risk. Okay? So as we increase the number of assets in our portfolio, we start holding more and more, we are going to get more and more of a diversification benefit. Okay? But at some point of time, you are going to have to face this market risk. You are going to have to bear this market risk. So this is something that you cannot get rid of. But this is something that you can get rid of. By holding more and more assets into the portfolio, you can get rid of this unsystematic risk and make it as small as possible, maybe even zero. Okay, so this is basically how diversification can help reduce unsystematic risk in your portfolio, and that's basically going to be better for us because you're not going to get an expected return for bearing unsystematic risk. So why would you want to take additional risk when you're not getting any return?